record this. And if you are joining us for this section of our market outlook, we are continuing with the Cetera Investment Management resources of the market and economic outlook. If you recall, earlier this year, we started off with three key themes that Cetera investors identified as potential headwinds and or tailwinds for the market this year. So we're going to give you a quick update on those three themes, give you an idea of where we are now and what's lying ahead in the near future. So three key themes that Cetera identified was the Fed's new cycle coming into this year. There was a lot of outlook or expectation that the Federal Reserve may be taming their interest rate hike coming from 2022 and 2023. We had aggressive rate hikes through those years, actually beginning in 2021 up until 2023, where we saw a pause. And now in 2024, the expectation is that the Federal Reserve may have cut rates. So we are in a new Fed cycle. Also, with the movement from the Fed or the reaction from the Federal Reserve with their rates, where would that lead our economy, right? There was concerns through 2022 and 2023 of a potential recession, especially if the Federal Reserve raised interest rates too aggressively or too quickly. So where do we stand currently on the outlook of the economy, whether we're still facing a harsh or mild recession, or if we could possibly reach a soft landing? And then third and final theme was election/volatility, where volatility is always a natural part of the market, but there are time periods or there are other factors that may influence the frequency and the severity of volatility that we see in the market. So those three things, we're going to start off with the Fed's new interest rate cycle. For those that may have heard, we have experienced a 50 basis point rate cut earlier or last month. So we have seen the first rate cut. There is still expectation that the Federal Reserve will have another rate cut by the end of the year. The approximate cut is expected about 50 basis point again, with a total rate cut of 1% by year end. The chart that we're looking at right now, you're seeing a lot of squiggly lines. You might be seeing some complex words like core PCE. Just going to give you an understanding of what chart we're looking at. So first, we're looking at the measurement of inflation. Core PCE is a reliable resource that the Federal Reserve is using to track their measure of inflation. And if you're not colorblind or maybe colorly challenged like I am a little bit, especially with small numbers and tight squiggly lines, there are three colors that you're looking at. You're looking at a dark purple, a light blue, and more so of a light purple. And all of those measures are different time frames or duration of core PCE. So in these examples, the core PCE that they're tracking, they're excluding food and energy prices. Not to say that they're not tracked, but this measure of inflation, they're looking at core PCE, which excludes the prices of food and energy. And what they're looking at is a 1 year track, a 6 month track, and a 3 month track. Now, the Federal Reserve, their target is 2% for core PCE, which is highlighted in that black dotted line going across your screen. And with each of those different measures, whether it's the 1 year, the 6 month, or the 3 month, you can see the light purple color, that 3 month, it is below their targeted rate, but it is taking some time for the 6 month and 1 year numbers to get towards that 2% rate. Some interesting things to make note of here, as I've had a lot of conversations specifically talking about inflation. It is important to understand that inflation is the rate at which prices increase. They're not the overall price level. So inflation is always going to be a thing because prices are constantly going to change, whether they increase or they deflate, i.e. decrease. But I thought that was an interesting point to make note of, is that inflation is the overall change in price and is not the actual overall price of goods and services. So why I say that is because as you're looking at the chart, specifically around 2024, you can see that PCE has continually decreased, specifically starting back in 2021, where we saw elevated levels of that PCE, where we were in 2021 coming out of the pandemic to where we are now. We have seen inflation decrease. Now, again, that's not saying that overall prices of goods and services have decreased, but the rate at which they increase has slowed. So there is progress that's being made towards the Federal Reserve's stance or target of 2% core inflation. But please understand that prices are high, but inflation currently is not as high. So will history repeat itself? Where we've seen aggressive rate hikes from the Federal Reserve that has led us into a recession. One of the key indicators that can signal a recession is the unemployment rate. And of course, in those gray areas, those gray boxes of the graph, you can see that those gray boxes signal some type of recession that we've experienced, most notably since 2000. You remember the dot-com era, where the dot-com bubble burst, along with terrorist attacks and things of that nature from 2000 to 2003. I believe most people will remember the global recession that occurred from 2007 to 2009. And in those periods, you can see inflation spike very aggressively. And where we are at the end of this graph in 2024, we have seen a slight uptick in unemployment rates. Currently, unemployment rates is about 4.2%. Ideally, that measure would ideally in a preferable stance would be lower than 4%. So we haven't seen a very aggressive or immediate spike, but we have seen a trend upward in unemployment. So where did that lead us? Following all of that information, we still believe, or Cetera Investors Management still believes that we are due for a soft landing. It is very possible, while unemployment has gradually risen and we see inflation starting to continually trickle down, it is very possible that we could reach that 2% core PCE number without having a hard recession like we've experienced in the past. So from an economic standpoint, borrowing costs taking the toll, what we're looking at here is basically a weekly mortgage application. So these are weekly mortgage applications on a rolling 4-week period. So it's not just day by day, but it's really looking at the 4-week moving average. What we believe with the Federal Reserve in their opportunities to cut rates, we could possibly see an opportunity to have an increase in mortgage applications, meaning more affordable rates to purchase homes, thus increasing the activity or the involvement in either refinancing current or existing mortgages or the purchase or acquisition of a new mortgage for a primary residence. Another indicator that we're watching closely would be manufacturing. So what you're looking at here on this slide or in this graph, the ISM is the Institute of Supply Management. They provide reports on manufacturing, purchase managers' input. So not only are we looking at the Institute of Supply Chain Management, but we're watching new orders of manufacturing. So why is this important? The Purchasing Managers Index is a measure of the prevailing direction of the economy, trends in manufacturing. So this is based on a monthly survey of supply chain managers across 19 industries, covering both upstream and downstream. In other words, opportunities, either existing manufacturing or potential opportunities for manufacturing. The value of the PMI and its movement can provide useful insight to business decision makers, market analysts, and investors. So the information here is something that is forward looking. And as you can see, that black dotted line is the black dotted line will signal if we're above, meaning there's expansion, or if we're below that black dotted line is contraction. So typically, if we're ever at a point where we're below the black dotted line, there is contraction within the manufacturing industry. So that is one signal that the economy is slowing. But with potential rate cuts on the horizon, that could provide new opportunities for those interest rate sensitive parts of manufacturing to see some expansion. So loosening up, this is tightening lending standards. So the 3 different measurements that are being tracked here, not just consumer, but we're looking at large businesses and small businesses as well. And what we're seeing is that the standards of lending, there are starting to be some loosening of standards to lend money out. Why this is beneficial is because typically if there's tighter restrictions on lending money out, that could lead to some concern that we are facing or leading towards a recession. As you can see in those gray dotted or those gray boxed areas, again, from 2007 or specifically 2008 until 2009 and 10, you can see that there were a lot more stricter standards or tightening of lending during that recessionary period. The same thing during COVID in 2020. Now as you can see in 2023, 2022 to 2023, there was a increase on that graph, meaning that there was more tightening standards of lending money out. But beginning in 2024 to where we are now, we have seen a lower restriction, which means more money is being freely sent out or lent out for opportunities to finance purchases, both for individual consumers, but also small and large businesses. So that is a positive sign that we may not see a harsh recession, but we are still experiencing some type of slowdown of the economic growth. Now, shifting gears to the market. So the first few slides, we talked about the economy and, influenced by the Federal Reserve and their interest rate policy. Now we're looking at volatility, which I think is a perfect time, especially with a upcoming election in just a matter of a few days. I do want to remind all of our investors that market cycles are not heavily influenced by political events. While there may be some belief and some understanding that politics do influence the economy, and they may have some impact on business market cycle, they're not the main catalyst. So on this graph that you're looking at, we're looking at the historical perspective, at least since 1930 or 1948, of the pre-election returns in the years of which there was a presidential election, both by party, whether Democratic, Republican, or by an incumbent party or a challenger party, and who actually won those elections. So this graph specifically, we're looking at the 60 days before the election. And you can see with the 60 days leading up to the election on average, regardless of who it is or what political party was running for office, you see that there's a net positive result in the 60 days prior to the election, but that's not absent of volatility. One important factor to understand is that going back to 1960, on average, the S&P 500 had a net positive return of 10.5% in election years in total. So while the graph is only showing the 60 days leading up to the election, on average per year, the S&P has averaged 10.5% in total. The differences in returns can largely be explained by outliers unrelated to the election. For example, again, early 2000s, we had the dot-com bubble burst for the stock market. So that correction or that crash of the dot-com era was not influenced or did not have any correlation to the upcoming election. Same thing with 2007 and 2008. While we were experiencing the global recession, the market volatility was not, again, determined or heavily influenced by the upcoming election that year. And even if we look post the results of the election, so pre-election was 60 days, this graph that you're now seeing on the screen is from the date of the election to the inauguration date. Even after the election, you see net positive results following the final decision of the election. So whether it's a Democratic president, a Republican president, whether the president is returning for second term or if the president is changing for their first term, the market is always resilient historically following the determination of the political makeup of Congress. Now, one thing that is important to understand is while the outcome of the election may not have a heavy impact on the market, their policies and things may have some impact. Right now, what we're looking at is with either presidential candidate that wins that position, they will experience some type of scenario where they have to determine the best way to pay for federal spending. As you can see highlighted in the blue lines, that's the expected federal spending from 2024 to the future. But if you look since 2000, about early 2000, we've been steadily increasing the debt deficit, specifically on spending towards other areas, either to stimulate the economy or providing opportunities for growth for the economy. So both presidential candidates, and regardless of the makeup of Congress in total, there's going to be some type of challenge that they both face in terms of determining the most effective way of spending that won't have so much of a heavy impact on our budget deficit or the national debt deficit. So what does this mean for markets with all that information? Start with the backdrop. The momentum and breadth in the market is improving. Large cap stocks, which are highlighted in that purple line signaling the 74.1, large cap stocks have outpaced mid and small, but diversification is still starting to pay off again. So that means, it's very important to understand the type of diversification you're taking within your portfolio. One, to make sure you're not overexposed in any unnecessary areas, but you're also allocating money where opportunities lie, whether they're in large cap stocks or mid and small cap stocks as well. When we're looking at valuations, the valuations of these companies, specifically with large cap, we're not seeing excess valuations like we've seen in the early 2000 period, from 2000 to 2003, when we were, again, experiencing that dot-com era. But it is very, I'll say, rhythmic as we're looking at the boom of the intelligence and the technology sector, specifically led by artificial intelligence. It is possible that we can continue to see growth in the market, but valuations, while they're higher than average at 16.59%, they're not quite excessively elevated like we've seen in early 2000s or another bubble type of era. Now, switching gears to bonds, I know we talk a lot about stocks, but it's very important to understand the role that bonds play. The yield curve is improving, so yields are, total return of not just dividends, but price valuation on bonds. This chart that you're looking at the comparison of a 10-year bond versus a 2-year bond and their total yield. What you can see in that purple line that's starting to get back to zero is that the yield curve is beginning to flatten, and we're starting to see a change in yields on 10-year and 2-year notes. So it's improving, which is a good sign for banks and maybe the economy. Banks pay depositors at short-term interest rates for savings accounts and CDs, which I'm sure most of you have experienced over the last year or even two, where money that you're keeping in your savings account, or maybe you recently opened in high yield savings account, you're starting to see a higher return on those monies. But they make money with longer term rates. Banks make money with longer term rates, such as mortgages. So when short term rates are higher than longer term rates, that's problematic for banks. So while we're seeing a shift in that does provide an opportunity for longer term bonds to have a better yield than shorter term securities. Credit spreads are tightening. This is going to do something with a type of bond called high yield bonds. The high yield spread over the risk-free treasury bonds remain relatively tight. So essentially what that's saying is the total yield on safer securities is remotely close to lower quality and supposedly higher credit bonds or higher credit instruments. So where investors were previously taking on risk to get a higher dividend or higher yield, shorter term and more secure securities provided a very comparable return instead. So we're still seeing credit spreads are tight. You're getting similar return with taking risk versus taking less risk. But as yields begin to change, you may see a reversion back to the previous days where short-term interest rates like CD rates, bank rates, and things are much lower than the total yield that you can potentially get on either higher quality bonds or lower quality bonds as well. So we are currently cautious on high value bonds. Still recommend owning them as part of a diversified bond portfolio, but we are mindful of the risk and return relationship in that asset class. So a few moving pieces, right? Again, lower rates where they can provide opportunity if we continue to see rate cuts from the Federal Reserve. Financial sectors like the banks, real estate investment trusts, utilities, and technology, those categories, whether in stocks or bonds, are very opportunistic with a change in lower rates. If we do continue to see a soft economy or a soft landing, companies or types of stocks that fit within the description of a consumer staple, again, utilities or healthcare, can stand an opportunity. And then with the election, just keep in mind, volatility is natural. The days leading up to an election, you may see elevated periods of market movement, but following the election, again, on average, there's always a positive result. So if you would like further information from Cetera Investment Management, feel free to follow Cetera IM on Twitter. They are X, commonly known as X now. They do provide a lot of insightful information as well. And I'll take a pause for any questions because I know that was a lot of technical information. So check the Q&A box. All right, got nothing filtering through just yet. So as promised, for those that do not have time to sit around for any other questions and answer, I will bid you all a good afternoon. Hope you enjoy the football game that's on TV tonight. For those that still may have a few questions, feel free to drop those in the Q&A feature.